Go. All right. Welcome to the call. My name is Jay McGee. I've been trading since 2017. When I first started, I was teaching in a classroom. I absolutely love my job. I got introduced to this information going into the summer while I was teaching. I spent the 2 months of my summer really diving into this information. And when I saw people making big profits, it really stretched my mindset. Fast forward 2 years into it, I started to really understand what was happening and start to see consistent profits. So I was making good money while I was in the classroom from my phone. And then I decided, hey, I told my husband, I think I want to come home. And then that was 2020. And so 2020, I've been a stay-at-home mom, and I homeschool and I teach Forex to the everyday people who just also wants to be afforded the option to be able to have extra income and continue to do what they love. So with that being said, recently I have locked in with an organization called Back at Zero. And I've been with them for about over a year now. And we have now grown our platform to over 3,000 subscribers. So I'm super excited about that. In honor of doing so, I wanted to have something more solid for people to be able to lock into. And what I have now is called the strategy reload. All right. So I'm going to go through the reload strategy, and but before that, I'm going to go through some very basic concepts that you should know if you're trading Forex. Once you see the basic concepts, then I will show you how to use my strategy. All right. In real time. And then I'll go over some examples of how we used it this week, and how they played out. All right. All right, here we go. I'm going to make sure I'm sharing my screen, and I am going to go to my PowerPoint for you guys. All right. Back at Zero is a free Forex platform that allows the everyday person to log in. We have free video libraries. We have free trading signals. We have free, or I should say, trading ideas. And we have free live sessions every week, and we have multiple 6 and 7 figure traders and 6 and 7 educators who are sharing their knowledge with the everyday person. And so I am one of the basic educators, and I wanted to share with you guys some basic knowledge and my strategy reload. All right, guys, let's get ready to reload with Jay McGee. The first thing that you need to understand about the markets is that there are three different trends. There's uptrend, sideways trend, downtrend. We call the sideways trend consolidation. Consolidation is just when the market is going up and down, and it's deciding which direction it wants to go. All right. And so when getting familiar with the trends, you want to understand that an uptrend is when the market is making higher highs, higher lows, higher highs, higher lows, higher highs. In an uptrend, you want to actually get in the trend when the market retraces to a low and get into a buy and make money going up. So when the market retraces in an uptrend, when it goes low, you want to look for a buy position. So as the market is going up higher and higher and higher, this is an uptrend. But at the lows is where you want to buy into the market and make money going up. So when the market retraces, you want to buy into the market and make money going up, right? So in a uptrend, we look for buy opportunities. In a downtrend, the market is making lows, lower highs, lower lows, lower highs, lower lows. When this market retraces upward, we look for areas to sell the market to make money going down. When the market retraces up, we look for areas to sell the market going down. Okay. In a good and perfect world, you want to trade with the trend. Write that in your notes. Trade with the trends. Sometimes in trends, you can identify parallel channels. Okay. This is just like where the market bounces. It's like an area where the market bounces up and down, up and down. So typically you can kind of understand or see that the market hits a zone and it's going to bounce down to a different zone. Once it hits that zone, right, it bounces up to the next zone, and you know it's about to bounce down, and so on and so forth, right? And so this is called a parallel channel, but this is still a downtrending market. So in a downtrending market, we want to look for sales here, sales here. Now, you could actually trade counter trend trade. So in an uptrend, ideally you want to look for buys, but if you want to take a sell, as you know, when it's going to retrace, you can do that. Just know that you're in a counter trend trade, and it can be a little bit risky, right? However, with the right risk management, you can still make great returns. Okay, it's just more ideal to trade with the trend in this aspect. So then you have the market making higher highs, higher lows, higher highs, higher lows in a parallel channel. Okay, this is called also a parallel channel, but this is with an uptrend. So we know that the market hits a low area. We look for a buying opportunity, right? Then the market will hit this zone, pull back. Some people will take a sell here, but ideally you want to take the buys in an uptrend. Okay. Now, there are areas where the market will start to let you know that the trend is changing. So in a uptrending market, the market's making higher highs, higher lows, higher and higher and higher. But when it starts to close below a previous level, like this, it's closing below, usually you can tell the market is about to change the trend. For example, in real time, this will be an uptrend, and then you see the market breaks this structure, okay? Because at first it was bouncing off of this level, but then it starts to change the structure, and then now you have sales. Now, this is a tip, but it's not the end all be all. But and for new people, in a good and perfect world, these green and blue candles represents buys, and the red candles represents sales in a good and perfect world. But there are people who change their charts to pink and purple, blue and orange, because they're more focused on direction. But just in a good and perfect world, on a like you just have a brand new chart. Typically, if the candles are green and blue, they're representing buys, and the reds are representing sales. So when you have more reds, you see the market is going down. When you have more green or blues, the market is going up. All right. And this is another trend change where the market was making lower lows, and then all of a sudden it pushed up and started making higher highs. Okay. Now, how do I actually enter the market? What I look for is when the market is going into an uptrend, when it pulls back, I look for areas of value. I look for areas where the market is either pulling back to a fair value gap or a BAS block, and then I look for a push up. Okay. So the market will come up, pull back, hit a fair value gap or a BAS block, right? And then we'll take a push up. Okay. Same thing here. The market pushes up and it finally fills this gap into an area of value, like maybe a great level of demand or a fair value gap or a BAS block. And then I take that buying opportunity. Likewise for a sell. If we have a downtrend and the market decides to retrace and pulls back, right, in an area of value like a great supply zone or a fair value gap or a BAS block, then I take the sell for the continuation of that trend. I always wait for pulls back. So it will look something like this. Say the market is selling, it pulls back, boom, I'm into that sell off of that area of value. If the market is buying, buy, pulls back to that area of value, boom, I'm taking a buy. All right. It's typically what happens. The market is selling, pulls back into that area of value, take a sell. The market is buying, pulls back into that area of value, I'm taking a buy. All right. That's where I'm reloading. All right. Supply and demand is very important because it just tells you areas where the market could potentially reverse. Okay. So you have an area right here where the market could potentially reverse, area right here where the market can potentially reverse. All right. So in this case, if the market was coming down to the zone, how do you know this market could potentially reverse and go upward? If you look left, okay? So in the past, the market has done this and shot all the way up. So, you know, it's potentially the market can respond and do the same thing on this side as well. So those are how you can kind of identify supply and demand zone, is where you have like two or more touches in those key areas. And I'll show you all of this in real time, but let's look at the supply zone. This market shot up, pulled back, came up, hit the zone, pull back, came back and hit the zone, pull back, right? Likewise for this zone, market came down, pushed up, came down, pushed up. And then we said, the market could potentially push up. Why? Because when we look left and see what the market did in the past, it's a idea for the market to potentially reverse and push up, right? So this is how we know we could potentially sell in these zones and we can potentially buy in these demand zones. And you can write that in your notes. Typically, you're looking for sales and supply areas and buys and demand zones. Now, every supply and demand zone is not going to be important, and that's why I say key areas. And I'm going to show you that in real time on the chart, but let's lock into these six steps. So this is my actual reload strategy, all right? So my 6 steps of how I actually execute the market is: number 1, I check the news. I check the news to make sure there's no red folder news that could potentially manipulate the market or kind of change my idea of what I see. Or maybe I want to just kind of secure profits if the market seems to maybe become too volatile during the time that I'm actually trading. All right. So for example, if I was scalping the market and I was in a 5-minute trade in indices and news was coming out and maybe our president was about to speak, and I know that, sometimes the market just kind of goes crazy during those times, depending on what's being said or what's going on. And maybe I'm up $500. I might want to go ahead and take partial profits, move my stop loss to entry, just in case the market decides to take a crazy reversal. Okay, during news. So those are just kind of, news is nothing to be scared of, but it's just always great to be aware of. Okay. Then I want to check the trend. What trend am I in? Am I in an uptrend? Am I looking for buy opportunities, or am I in a downtrend and I'm looking for sell opportunities? The next thing I want to do is identify major supply and demand zones where the market could potentially reverse. Because let's say I'm getting into a sell. If I'm about to get into a sell and I'm in a demand zone, more than likely the market can reverse crazy on me. So I want to be aware of where I'm taking those entries, because if I'm at a major supply zone, I don't want to take a buy immediately. I want to reevaluate and make sure I'm doing the right thing versus taking on those zones when the market is probably going to push back and reverse. Then I'm looking for my key retracement areas. Where's the market pulling back to? Is it an order block that's near, or is it a fair value gap, or like I said, is it just a key demand zone or a key? Then I want to set my parameters. Am I going to take an entry for a sell or entry for a buy? Or on the trading view, it actually says long, which means buy, or short, which means sell. So write that in your notes. Long is going to mean buy. Short is going to mean sell. Then I want to set my risk. Okay. And this is the reload acronym. This is something that you can screenshot and no, this is how Jay McGee is teaching you guys to actually have a plan. The very first thing you're going to do, so it's in the acronym. This is the same 6 steps, but it's within the acronym reload, so you can remember. The R, read the news. All right. E, establish the trend. Okay. L, locate my zones. Where is my supply and demand zones? O, observe the key areas. Where are my fair value gaps? Where are my order blocks, or what we call BAS blocks? A, apply the trade parameters. Okay. Where am I going to enter, take profit, stop loss? And then D, I'm going to determine my risk. Okay. How much actually for my lot size, how much money am I risking to gain? All right. These are the key components for that 6-step strategy. All right. Read the news, establish the trend, locate my zones, observe the key areas, and then I'm going to apply the trade parameters and determine my risk. All right. So now I'm going to show you 2 examples of how we would look at the market. Okay. All right. So let's look at Bitcoin, since it's already on here. We talked about this this was Wednesday. Wednesday, we set parameters for Bitcoin. All right. Let me take some of it off. Oh no. Oh well. I know I'm gonna just take all of this off. Let's do this. Since I deleted that, I'll put it back on. Um, let's do this. All right. So I think we had this. This is where our fair value gap was. All right, so let me take all of this off for a second. So just briefly, I'm gonna share. This is our BAS indicator. So if you are trading with back at zero, um, once you get access to our artificial intelligence, you'll see the logo on your trading view. You'll go to indicators, and then you'll go to invite only. Click on BAS, and then it will pop up. You would have to go to settings, and basically, what I do is I check everything off except for the breaker block. And I taught this, and I do teach this in my basics classes, but I'm not going to go over this too much today. All right. Now, what this does is it gives my key BAS areas, my key BAS blocks where the banks are hiding out. Because you got to understand this. We're just small players in this big entity, right? So the hedge funds, the banks, they're going to be in these gray and yellow areas. That's why these are key supply and demand zones. So I'm not looking for every single supply and demand zone, but these key areas are going to keep me clutch. Now, this is a freebie for just people who are watching and not connected with BAS yet. If you go to indicators, go to FVG and click on fair value gap nephew Sam, you can get that one for free. That was a freebie. All right. Now we're gonna get the fair value gaps put on these on our artificial intelligence soon. We don't have it yet. Now Wednesday we were looking at Bitcoin, and it had a fair value gap right here for a sale. When we said, okay, what is previous going on in Bitcoin? We saw that previously it was coming from a sale. Previously, we saw the market selling, and then it was pulling back into a fair value gap. So what we did was we went to our forecast and we clicked short. And how I enter my trade IDs is my entry is always at the entry is at the bottom. If I'm getting the sales, my entry is always at the bottom of the fair value gap or the BAS block, whatever I'm looking at. And then at the top, a few pips above the fair value gap is where I have my stop loss. Now, why did we take this trade, or why did we decide this was a good area to sell? All right, so we knew that the market had came into buy side liquidity, right? And it came into our fair value gap. So once it comes into our fair value gap, if you're selling, I want a red candle to close beneath it, which it did, right? And then once it does that, I typically want a pullback on a smaller time frame into, so it could be like a 1 minute trade where the market comes in and pushes in, and then once it does that, come to the entry, boom, I'm into the trade, right? So let's maybe look at the 5 minute and see if we see something like that happening. All right. So here we had a red candle close out on the 5 minute. Let's look at the 1 minute. Typically, again, on the smaller time frame, once the market has a candle close out, we have one pullback. So here we had a candle close out and a small pullback here. And so this is where we would have entered the trade. Sorry, it's so small. I want to draw. Okay, wait till mommy gets off. Okay, I'll call you in a second. All right, so we have the entry right at the front of the BAS block, and then we have a small stop loss below, on top of the BAS block. So our entry is where the red and the green separates. Okay, so this first little line here, and then our box at the top is going to be a few pips below your key area. So whether it's a BAS block or fair value gap, that's where you're gonna have it. So for this particular trade, I'm risking 20,000 pips. 20,000 pips, and then I'm gonna do a 1-to-3 ratio. So my first TP is gonna be about 20,000 pips. My second TP is gonna be about 40, and third would be about 60. And so you would see right here, I'm trying, y'all, get this at 3. Okay, so you see right here it says ratio 3. You know you good. So basically, the market came into this structure, right? Closed out, pulled back just a little bit. Boom, you get into the trade. And as you can see, it hit all 3 TPs. That's what we projected last time. That was for Bitcoin. I'll show you guys another setup. Do we have gold on here? Let's look at gold. I feel like gold was a good example. I even think actually US 30 was a great one. Let me check that one out. Let's see what we had here. Let's go to 1 hour gold. I should have pulled up my notes from class. I just kind of jumped in all of this, but let's see. All right, here we go. So as we can see, we had 2 entries for gold. Y'all see this? This was probably on Thursday, and this one was on Wednesday. But as you can see, gold has been making higher highs, higher lows. Higher highs, higher lows. So it's been in an uptrending market. So we're looking for key areas of value to mark up the charts. All right. Now, we talked about the indicator before, but again, on this call, I'm not going to go too much into detail. Just keep coming to my class and I'll keep going over the indicator, how it works, and different things like that. We really took our time going through a lot of these key components, but for time's sake, I won't be going over that. Just kind of how we look at getting into the market from what we know and what we have. All right, so we have an uptrend, right? Where the market pulled back into this key area. This is where that fair value gap was. So we're going to mark it up here. All right. And as you can see, the market came into that fair value gap, right? Broke out. We would have found a pullback on a smaller time frame. This would have been our entry. And as you can see, it dominated, right? Dominated the markets. All right. So let's say you missed this move. You're like, I missed the move. And you saw another fair value gap. This is where that other one was marked up. Now remember, the green fair value gaps represent the buy opportunities. The red represents the sell. And I'll show you guys that more in real time. I'm just going over our homework that we set. All right. So again, the market pushed up. We had on our higher time frame, higher time frame, we had that 4-hour fair value gap right here. As you can see, the market gave us a bullish run, bullish candle on a smaller time frame, pulled back into our entry. Boom, we took the trade. That's TP1, pulled back. It still didn't stop us out. TP2, and it's headed to TP3. Now, mind you, let's say you missed the first entry. We have another area, right? Let's just say we didn't see none of this. So I'm going to clear all of this. Let's just say since today's Friday, the market is closed. So 1, 2, 3, 4. Let's say 4 hours before the market closed, maybe around noon or so. We saw that the market was in an uptrend. We saw that this market pulled back into this zone. All right. We have a area of value. All right. So we have an uptrend. And we know where our supply and demand zones. We saw the market pull back into this BAS block, all right, because the yellow represents the buy BAS blocks and the gray ones represent the sell BAS blocks, right? So the market pulled back into the zone. We had a break with this big blue candle. Let's see if on a small time frame it gave us a entry. This candle still was very bullish. This 15-minute one, very bullish. Let's see if the 5-minute was very bullish. It looked like this one just kind of came out the gate. I'm not gonna lie. This one, that's 5 minute. Let's see 1 minute if it gave us a 1 minute pullback. This one just looked like it took off. But typically on a smaller time frame, this one just kind of pushed all the way up. Typically, it'll close above. If we're taking a buy, typically it will close above the BAS block, and then on a smaller time frame, it'll kind of reverse a little bit and let you get that entry before it take off. This one just shot all the way up. So that entry was just that was a very tight entry. But in a good and perfect world, obviously, we would have wanted to be in that. Oh, by the way, so we were looking at a 4-hour, but if you look at this 1 hour, this was the entry. The market came out on this smaller BAS block, pushed out, had a bullish run, pulled back a little bit on its entry and shot up. So on the smaller time frame, it actually did give you the setup, but it gave it to you on the smaller BAS block. That's what happened here. So it then shot up. But again, we set our parameters. So let's say you got in a 4 hour. What was that? What we was looking at? Let's say you got on that BAS block on 4 hour. Let's do this. How you would have set your parameters. Okay. You would have did like got your projection, got your long position. This would have been your entry zone. Few pips. Push this up. Few pips here. And it never hit our stop loss. Because once it broke here, this is where it would have broke, right? And then on a smaller time frame, you would have got that little. Actually, it would have been here. You would have, if you would looked on a smaller time frame at the BAS block, this is the area it would have. It pushed up, pulled back, then shot up. However, even if you enter it here, without it, let's just say hypothetically, without it closing, you just got in here. I mean, it would have never hit your stop loss. And then if you would have looked on a smaller time frame and got in here, yeah, would never hit your stop loss, because we would have never bought anywhere here. I mean, if you did buy here, market pull back here, then it stopped you out. But if you were waiting for the market to give us that bullish momentum, then yeah, here. Or let's just say it stopped you out the first one, and the second one, you got your money back and some, because the market doesn't always happen immediately. So, you also want to give room for error. I'm not going to say every opportunity is going to do what you want it to do. All right, so Euro USD, this was the other one. This was a 1 hour fair value gap. Let's see. Or maybe it was a BAS block. Not really sure. I think it was a fair value gap. But it's also showing a BAS block in that zone too. So let's just use the BAS block for now. All right. Well, no, let's not, because I think this happened after. This kind of after. Anyway, we had a fair value gap here. Market broke up, pulled back, came up here. It didn't hit all the TPs right away. It hit this probably like a TP1, and it pulled back. If you would have kept your stop loss here, then it would have stopped you out, right? But if you would have brought your stop loss to entry, right, took partial profits at the first, which write this in your note, because I always talk about this. That first TP, take partial profits, move your stop loss to break even. If you don't want to do that, then it's a possibility of it coming back out and then pushing back up like it did. So you see how in this zone that we marked up, it came back down, but it pushed all the way back up, right? Now, mind you, if it would have took you out, you still could have had an opportunity for this BAS block. You see the blue breakout, and then the market pulled back. You would have entered in this area, and you could have took that again. Okay. So these are ways that I utilize the market, and we'll talk more about it in our class. But just for keeping this video short, I'm going to go ahead and stop my recording. This has been Jay McGee, and I will have this on YouTube for you guys to check out.